All right, so let's get going. My name is Mercedes Bankston. I'm the director of the London Founder Institute. I'm actually going into about my fifth cohort. I've mentored in Silicon Valley, Israel, Turkey, and obviously London and the European Union. One of the things I'd probably point out is no matter what location you're coming from, because I know this is a pretty international audience, the investment journey is typically the same. Investors look for the same type of criteria. And we're going to discuss a lot of that today. So one of my roles as a director is to make sure that I can take a company with the idea and take them to launch at the Founders Institute, or take a company that has a MVP and take them to the next level, ensuring that they have the best success in raising funds and the best terms possible. I always feel that having the best terms possible and the investment journey is the best thing that you can do. I know that there's a lot of companies that are always offering funding, but those terms aren't always so great, and that really can impact your capital. And I think that's one of the things that we'll touch base on a little bit today. So we have two panelists that are speaking. One is Richard Blakesley from Capital Pilot. He's going to talk a little bit about their investability rating, where they combine human research and analytics with algorithms to produce an assessment of your investability of your company. And then we have Anthony Rose from Seedlegals. Anthony and I have worked quite a bit in the past. He's probably also one of the most well-known people, I would say, in the UK, with 15,000 people on, or 15,000 companies on Seedlegals. They're the largest funding for closed deals in the UK, and they have about 300 million invested via Seedlegals. So with that, I think I'll just go ahead and let Richard go ahead and begin, and we'll go from there.
Mercedes, thank you very much. And I'm delighted to be talking to you this afternoon. What I want to talk about a little is the hard yards of fundraising. As Mercedes was just referring to now, it's not a straightforward process. We're obviously in interesting times right now as well, which doesn't necessarily help the situation. But let's start talking about some of the background to fundraising and some of the background to the marketplace in which we're all being asked to operate. We have effectively a marketplace for early stage funding, and as Mercedes said, it's the same in the UK as it is in many other parts of the world, which is inefficient and unscalable. And it's bizarre, right? Because if we're looking at a marketplace which is about innovation, how is it that so much of the processes that we're talking about are uninnovative? And if you look at where the early stage investment market sits in this spectrum of efficiency and liquidity, we're right down at the bottom end of it. So at the top, the public markets, the public stock markets. Here we've got all sorts of tools that enable high volumes of trades to happen at highly transparent prices. So there's lots of price efficiency, lots of price availability there. And that's about indexing, it's about high volume, and about transparency of all the deals that are happening in the market at any one point in time. One level below that was an example. We've got the real estate market. We all kind of know what a square foot or a square meter of property in a particular part of the world is worth, because there are quite a lot of transactions. There's a medium volume of transactions, and there's semi-transparent pricing. And we value businesses, or value real estate, based on comparing this property with that property based on its location and its square meterage. And then way down at the bottom of the track here, we've got the early stage investment market. And the early stage investment market is almost prides itself on this opacity of pricing. It's really, really difficult to see transparently what's going on in this marketplace. It's a low volume market, and valuation is driven by the investor. He who has the gold makes the rules. It's the golden rule. So we have a situation where there's low transparency, low volume of trades, and as a result, low efficiency. And we'll talk a little bit about why all of those things really matter. Low efficiency is a real driver of the entire marketplace. So if we look at the top right here, we've got closed networks of investors, whether that's VCs or angels. Think about the sorts of things that we tend to hear in this marketplace. I'll only talk to people looking for money if they're introduced by somebody I already know. Have you been to Stanford? Have you been on the Y Combinator program? Okay, well, maybe I'll talk to you then. And I'm not going to send out my details because I'm worried I'm going to get spammed by too many people looking for funding. So that's key issues in that part of the marketplace, as a result of which we, the founders, undergo quite significant wastage of time and talent in that investment process, because we're scratching around trying to break into these networks. And Founder Institute, obviously, amongst many others, is a key driver of this ability to forge ways into some of these impenetrable networks. As a result of all that wastage of time and talent, we have low volume and, interestingly, limited diversity and diversification in early stage portfolios. So lots of stats about what a good early stage portfolio should look like. It's not 10 investees, it's 100 investees. And you get better diversification with better diversity. And if you've got a closed network, you get neither. As a result of that limited diversification and limited diversity, we see modest portfolio outcomes overall from the VC sector, modest to poor visibility on what returns these funds are actually generating, as a result of which the capital providers, and let's remember that the VC funds here are not the capital providers, they're kind of intermediaries. The capital providers restrict the amount of capital that they're willing to provide into this sector. And wouldn't it be fantastic if we could forge a new way of doing this, which meant that more capital could come into the sector more efficiently, wasting less of everybody's time and creating a much more transparent marketplace. Now, one of the key things that we've got at the moment, as well as that generic situation, which has persisted for years and years, for decades and decades, is a fairly historically low risk appetite from investors. I've looked at the gold price here, and the gold price is a reasonable indication simply because gold price goes up when investors are risk averse. And we are right now looking at a historically high gold price. Gold has never been priced so high. Now, there are other factors for this, but it's just worth bearing in mind that right now there is clear evidence that your average investor is not looking to take on significant risk, which isn't necessarily fantastic news for our sector. Now, one of the things that we've been doing, and here's a brief 30-second infomercial, Capital Pilot, is to build systems that break through this opacity. And as Mercedes was saying at the beginning, we are a ratings agency. We have a system which rates businesses based on their investability, giving you a number like an Equifax or an Experian credit score. And in conjunction with Anthony, who you're going to hear from later, we are launching a fund, the 50K Boost Fund, which will invest automatically on the back of that rating. So a company comes to us and gets a rating, and if that rating is high enough, they automatically get £50,000. Not launched yet, we'll keep you informed, but that is the plan of how we take this forward. We bring automation and data capture to create that transparency in the marketplace through our rating, and Anthony and Seedlegals bring along the really important additional piece, which is the ability to complete transactions very rapidly and very efficiently. So we're breaking through the VC inefficiencies as well as the completion mechanism inefficiencies as well. So overall, what do we take out of this as founders of businesses? One learning from a very reputable person, a great quote here: spending 25% of your life as a founder in fundraising isn't very clever, and it's not really a badge of honor. So there's this mythology around fundraising that it's a kind of a cool thing to do. Well, I would say it's not a particularly cool thing to do. It's something that you really should avoid if you can, but many of us can't. So if you can generate revenues to cover your costs, if you can get other forms of funding which are less painful to achieve than equity fundraising, please go ahead and do that. So recommendation number one from Capital Pilot, which is a fundraising organization, is try not to fundraise. But if you can't avoid fundraising, then here are a few thoughts and tips about how to make it as efficient and as pain-free as possible. Remember, first of all, that fundraising is a sales process. Now, many of us sell our own product or service day on day. And why would we not use exactly the same processes that we use for selling our product or service while we're trying to raise funding. Starting off with the idea of investor need. What is it that the investor that we're talking to actually wants? What is it that they're actually trying to achieve? And how do we get to the point of being able to identify and focus on the specific investor? And if it's a VC, that might not be the fund, it could be the individual at that fund that you're looking to engage with. So who's your target audience? How do you speak to them? What are their hotspots? What have they done recently? And how do you fit into that process? Working smart, really, really important. You know, you can work very hard at fundraising by a scattergun approach, but by, as the next point suggests, building a really good sales funnel of qualified leads and qualifying and requalifying those leads as you go through the process, and figuring out how the best way is to connect with those organizations as you go through that process. All the things that you do in a normal sales process for your product or service, bring it into your fundraising process as well. Fit versus quality. This is here for a particular reason, which is 98 times out of 100 when you approach an investor, they're going to say no, maybe, or maybe they'll just be silent. And you're never quite going to know necessarily why that is. It might be because of fit, or it might be because of quality. So as long as you are confident about the quality of your investor proposition, skipping a couple of segments round, proposition, not pitch, although the pitch is obviously important as well, then obviously you should be in great shape to take a no from an investor as being a fit problem rather than a quality problem. So make sure your quality is great already up front. Brief 5-second infomercial. Our rating system and assessment system is designed to do exactly that, to tell you up front that your proposition is in great shape before you go to market. So then you can start looking at fit, which is about the sales funnel. Another piece about all of this is sales versus marketing. And this is really raising the point about the very many events that are available to you as founders at any point in time, online, face-to-face. Many of these look like they could be sales opportunities. Come and pitch at this pitch event. Very often they are marketing events because very often there won't be very many investors in the room, if any. So be aware of the distinction between sales and marketing and plan your time accordingly and make sure you know precisely why you're signing up to that event or that service and what the reason for that is. Pitch versus proposition, we touched on that very briefly already. Really here what we're saying is there are many things that are important about your story to the investor, and only part of that is how you tell your story. The vast majority of it is about the attractiveness of your market, the fit of your business opportunity and business proposition in that market, the scalability and growth prospects of that opportunity, how that converts into value for investors, and obviously how you're expected to execute on that. And we'll come back to that in just a second. Process planning, let's repeat it. If you can build a great sales funnel and drive through that sales funnel in a highly organized way, you are much more likely to be successful in the longer term. And if you can build a feedback loop into that sales funnel, into that process, which is to say, what didn't go so well in that last approach to that investor? What can we learn from that to build into our next approach? So much the better. Did slide 3 work well, or should I rebuild slide 3 or move it back so it's now slide 8? All of these various different elements so that you're constantly looking to rebuild and improve your overall proposition and presentation. So it's all about what does your audience need? What does your audience want? What do they need to hear from you? It's not you telling your story about how clever you are. It's you telling your story about how great your investor proposition is, how you're going to make your investors money. The best proposition in the world isn't going to survive poor execution. And this is a key truism for across the industry. So we're really ultimately talking all about team. And within team, what are the investors looking for? The investors are looking for evidence that the team has already done everything they possibly could do to take their business forward on the minimal resources that they probably had available to them before they get their fundraising traction. What can you prove in terms of what you've done already? It doesn't have to be revenues. It might be testimonials. It might be a few people that have tested it. It might just be your mates who tried out what you're building and said that it's great and given you some suggestions about how to improve it. What about milestones? What are investors going to get for the money that they're giving you? How long is it going to take you to achieve the goals that you're setting yourself? And do they look credible? Credible ambition, really important point here. Yes, you're ambitious, you want to build a big business, but is the stage by stage approach that you're taking to get there credible and reasonable? Appropriate expertise, obviously really important. It's a bit more basic, and this is about really identifying the fact that you have the right domain knowledge, the right technical skills available to you or to be available to you as a result of funding, but at least that you've thought about what you need to build the business. Behavioral fit, weird one here, right? And this is often expressed in the, oh yeah, well, I like to go out for a cup of coffee with the founders just to make sure that they're the right sorts of people. But really what we're talking about here is those individual qualities which will make a business more or less successful. And they may be things like tenacity, persistence, and energy. They may also be things like coachability, so flexibility, and the reasonableness and clear-headedness that needs to be brought into any situation to realize when things aren't necessarily going quite right and what can be changed to make them go better. I was about to use that word that I hate, which is pivot, but I won't do that. Accuracy and precision in the way in which the business is organized. So this is looking at the, whether it's financial forecasting or sales or marketing planning, all of the various different aspects of the business. Are they dealt with in an accurate and precise way and described in the right sort of way? And ultimately, all of this is about groundedness. Yes, ambition. Yes, big plans to create something of significant value, without which none of us would be doing what we're doing, but with an other element of groundedness, which means we can see practical obstacles and figure out ways to overcome them. So really what we've discussed here so far is a general approach to the not particularly pleasant process of fundraising, and some approaches that can be used to ensure that as you go through that process, you're maximizing your chances by ensuring that the process that you're creating is as robust as it possibly can be. Now, at this point, I'm going to hand over to Anthony, who's going to talk in more detail about some of the specific aspects of fundraising and the more technical aspects of fundraising that are necessary to create success in that process. Thank you very much.
All right. Thank you. If you switch off first, great. All right. Hey, and I've got the sun streaming in. My camera is having a hard time dealing with it, but hey, it's beautiful weather here in London, so why not? So hello, I'm Anthony. I used to head up BBC iPlayer some years ago. After I left the BBC, I built a startup. I sold it, built another one, sold it, invested in a few, got tired of paying lawyers, and built Seedlegals so no one has to go to lawyers again. So if you're doing your funding round in UK or France, we'll get to other countries later, come to Seedlegals. But what I want to talk about is all about maximizing investability. So my briefing from Mercedes is that many of the people on the call are super early stage, you've had an idea, you're looking to get investment, or you built an MVP and it's really pre-traction and so on. So how are you going to get investors to invest in you? And so I thought I'd have some fun and we'll go through that, and I'll look at it from two perspectives. One of them is maybe the art of the pitch, as I call it, and the other one from the legals. So let's start with the art of the pitch. In later stage rounds where your company's got revenue, a private equity investor or a VC just looks at your Excel spreadsheet. They probably really don't care about the founders very much. They don't care about anything. If the numbers go up, they're in, and your valuation is a multiple of the amount of money you're making each year and the rate of growth. And whether you are flying planes or taxis or food, your later stage investors, it's all about the numbers. But before that stage, nobody really knows whether it's going to work or not. Let's say you've got this hypothetical idea and this amazing GPS-controlled, Wi-Fi-enabled bicycle lock that if your bike's stolen, it will track it all the way around town. Is it a good idea or not? Who knows? You don't have customers yet. You don't have it developed yet, potentially. So investors are really betting on partially you, but I think largely, and I think this is where we're recognizing it's what's in the head and what's in the heart. They're looking to extract any little bits of signals from the noise to work out of all the companies coming their way, whether you're the ones that they should be investing in or not. So how can you maximize that? Now, there are two ways that investors are going to find you, or you're going to pitch to them. One of them is you're going to send them a pitch deck, and they might read it, and we'll get to pitch decks in a moment. But the other one is you're going to go and talk to them. It used to be standing up at Runway East or at an FI event and pitching to people. These days, it may well be on a Zoom session instead. So what I want to do is start with the art of the pitch. And now I'm going to turn on screen sharing. So, so with the art of the pitch, my baptism of fire in this, and I think it's a fun anecdote because for founders, you know, often founders are introvert. For me, I'm a tech guy. I would spend, you know, my youth in front of, you know, circuit boards and books and stuff like that before computers, and standing in front of lots of people didn't come naturally to me. So I thought it would be fun to say my baptism of fire on this. So many, many years ago, I was doing real-time 3D graphics, and we were selected by Intel to be on this Web 3D roundup in Los Angeles. It was a huge event, and we were one of 30 companies that had 3 minutes to pitch to an audience of 3,000 people. Now, our company had sponsored some of the drinks beforehand, so people were slightly inebriated. They had whoopee cushions, and if your presentation was boring or your real-time 3D, if it crashed, you'd get whoopee cushioned. And they were also armed with ping pong guns. So if you went over your allotted 3 minutes, even by a second, you'd get shot. So in the pre-trials, our 3D engine had crashed pretty much every time. And I put myself forward in the company. I was CTO and insisted I do this presentation. And our company really needed investment. So if it didn't work, you know, that would be really problematic. So no pressure at all. Anyway, on the night, and there's actually me just there. I've had a haircut since then, and you can see a huge number of people in the audience, and you can see people shooting things, fortunately not at me. Anyway, it turns out we didn't win, but I think we came second, but our 3D engine didn't crash. And at that point, I got over stage fright. So now, and here's why I'm mentioning all of this, when you need to present and you're on stage, what I do is firstly, I think about who's the audience beforehand. And of course, on Zoom, it's somewhat harder. I'd otherwise go and talk to the audience and find out what are they there for, what are they looking for, and so on. And then I think to myself, are there 3,000 slightly inebriated people in the audience who are going to shoot me if I go over the time limit and use whoopee cushions if my presentation's no good, and my company's probably going to be out of business if it crashes? No. Great, I can relax. So with that over, you can now be on stage and you can be pitching. And whether it's on stage or to an investor directly, the same rules apply. So now, here's my thought on the set of things that your pitch should cover. It's a bit different if it's a pitch deck or it's a verbal pitch. But what I'm going to go through is the things that I think investors are looking for, and that's what you now want to convince them about so that you're going to be the one they invest in rather than someone else. Because as Richard said, you know, getting investment is hard. So everything that an investor is going to want to see is that your company is going to go from an idea that you've got to a product that consumers love, not a pet project for you. They want to see that it's a real thing that real people want. So when I see a pitch deck, one of the first things I look for is this solving a real problem? too often I see pitch decks where the founder's got some personal thing, or they want world peace, or they want the world to be a better place, which is fantastic. But unless it's something that people actually want, then it's going to be hard. You may spend lots of money building it. I think that the other part of that is that your pitch should be all about why people want it. When I see pitch decks, or even pitches on stage, I see people saying how clever it is, the thing that they're building. They tell you all the stuff they're building. It's blockchain this, and I do this, and nobody cares. They only want to know why they may use it. And I realized that after I launched our Seedlegals first version of our website. It spoke about document automation. It spoke about contracts creation. And then one day I woke up and realized nobody cares about those things. No one wakes up in the morning, I need document automation. And so I changed it to the fastest way to complete a funding round, because that's what people are looking for. So it's all about figuring out what the audience, your customers, and in the early stages of pitching, the audience are your investors. So the next thing we've covered, the problems that people are looking to solve. So the next thing is, has anyone done this before? And at Seedlegals, I see a lot of pitch decks. And I'm sometimes amazed that when I see a pitch deck, and I haven't come across, that's not my area of expertise, but even I, in a few minutes, with a bit of Googling, or even just without needing to Google, know several competitors that the founders don't know about. So thing one is, make sure you know who is your competitor today, and also go back in time, because many things are not new. They've been done before. When I see, for example, Quibi, the much hyped now company that's raised hundreds of millions, if not billions, to create short form video. And no sooner had it launched, we now read stories of its imminent demise because they don't have users. And I was thinking, you know what? The guy from Hulu created something called Vessel a couple of years ago, which sounds remarkably similar, and that didn't work. So you should do your homework to figure out who's done this before, and did it work or not. And you want to do this for two reasons. One, so you understand why it didn't work. And two, when an investor asks you, you can explain to them why that's the case. So the next thing is, are the founders the audience? So when I see founders who are passionate about a particular domain and they know that domain, that's amazing. But sometimes founders have an idea that's in a different space. I'm going to do something for wills or probate, or I'm going to do something about, aircraft hires, whatever. You pick something, but that's not something that you're an expert in yourself. And when I see that as a bit of a red flag. So if you know the space intimately and you're a consumer of your own services, that is fantastic. But if you're not, life as a founder is very difficult. And on one of my previous startups, I found that initially I was very much our audience. But as our audience started getting younger and younger, one day I realized that there were like 15-year-olds using the product. And I have totally no idea what 15-year-olds wanted from, what type of phones they've got. And then you have to go and find someone in your team who proxies for you. So now, if you've been following the chat, Shaheen asked a question about, finding a technical co-founder. And I think it's worth spending a few moments on that. So for me, in a startup, I think there are three roles that you need to fill amongst the founding team. Number one is the domain expert. So somebody who knows the audience. They, the person is like street. So it might be the doctor with the dialysis, his mother, her mother, something or other, really passionate about and knows the pain point and why the vision to change the world around that. The second role is the tech/product person who's going to help deliver it. Because the problem is the visionary may know that segment very well, but often may be completely unable to figure out how to deliver it. So the doctor may know the audience but has no idea how to build a web app or even to talk to the people who are going to build a web app. So, you know, the second role usually aligns to a CTO role. And the third role is the Mr. or Ms. Money, somebody who's going to be maybe the COO or help on the investability to make sure there's a business case, to make sure the company's going to make money. So now, when you look to yourself and your co-founders, if there's more than one of you, you should see, you know, look within and see which of those three roles is you, and then you want to complement yourself with the other roles. And so, you know, in my case with Seedlegals, it was actually my business partner's idea. He's the ex-serial angel investor and genius ex-VC, and he identified the problem space. I'm the tech product guy, and thanks to having some startups and investing myself, I know that space, but I'm really the guy who's going to help build it. And between us, we've both been around for a while and can handle the financial side. But it's important, therefore, that you find, I think, those three roles. Now, sometimes it might be you across all of them, and sometimes you might need one or sometimes more than one other person. And my data on Seedlegals, with thousands of companies on the platform, you know, we can see, because you tag who's the founder in funding rounds, we see that the most common is 2 founders. Sometimes it's 1 and sometimes 3. And we actually see that rounds close faster if the company's got 2 founders than the others, because investors like that. It doesn't mean you should ditch one of your founders or you have to have 2, but 2 seems to be a good number because you find someone to complement what you're doing. And the reason for mentioning this is, as the investor, I would be looking to find the founders that cover the 3 roles and complement each other. So the next thing as the investor I'm looking for, particularly super early on, is it run like a military operation? So there, too often I see the standard problem, right? So you've had an idea, you've got a day job, and of course, should you give up your day job, or is it madness to do that? Someone's got to pay the rent. Or maybe you are plunging into your new business 24/7, but your co-founder's still doing the day job. And then they're saying, when I get investment, I'll give up the day job and now join full time. So what I like to see as an investor, and what you need to show investors, is you are super focused. You're focused on only those things that will be successful. And here, what I like to figure out is, when I see pitch decks or when founders ask questions, maybe they'll ask me, should we move to the US? Should we move our company to Delaware? And here, to me, it's all about laser focus. Your company will be a success if users are buying your product and using your services and telling their friends. Whether you're incorporated in London or Delaware is not a success factor. It may be great for tax or something in years to come, but if you're going to spend weeks working on your product to make users love it, or weeks spending time and money with lawyers to move your jurisdiction, you should be focusing on the stuff that is going to get you a product that people love. So to me, it's all about, I look for laser focus and the founders on just those things that will make the product and business success and scalable. So the next thing that I see in a pitch deck, and notice for everyone, is that what I see founders do is they think it's going to impress investors if they show them all the stuff they're going to do. I'm going to have a B2C app, and then I'm also going to have a B2B proposition with APIs, and then I'm going to build a Tableau database, I'm going to sell data, and I'm going to do it on blockchain. Because you think that by showing this big vision to investors, your company is going to be more valuable. But actually, as the investor, you're probably going, that's more money down the drain. There goes my investment. There goes a higher burn rate. So what I like to see is I like to see the company focused on one thing and doing it really well. And of course, if you've got 50 developers, you can be doing a B2B and a B2C product. But when I see a pitch deck where I see the company doing lots of different things, my first question is, So how many developers do you have? And they go, 3. And I go, well, you know, if you're trying to do all of these things with your 3 developers, you're doing each one of them way less well than your competitor. There's their website that's got their 3 developers or 10 just doing thing X. So my counsel is, pick one thing and focus just on that. And then what you want to do in your slide deck is you want to show your investors that this is going to be V1. Your investment goes to fund this. I'm not wasting money on all this other stuff, but I've also got V2, my vision, which is, it's not limited just to this little thing. There is a big vision, but I'm only going to start doing that vision once I have traction and revenue. So I'm going to get to success with your money and a return on investment essentially on this limited piece, and only then am I going to look to ramp up greatly for later. So I've covered also the do one thing and do it right. That was the focus. So the next thing I think is customer driven development. So here I see, when I look at a slide deck, you know, as I'm scanning it, I'm thinking, of course, the reason you're a founder in the first place is you've had some vision. You've seen something that can be changed in the world. You've seen an opportunity. You want to disrupt something. And of course, you don't yet know if people are really looking for that solution. You have to build something before you'll find out. But if people get too caught up in their own drinking of their own Kool-Aid and just go and build stuff without listening to customers, you're at serious risk of spending months or years building it and consuming huge amounts of investors' money, and then ultimately nobody wants it. So what I love to see in a slide deck, and what you should be doing, is rapidly prototyping, asking customers and getting feedback. And then I like to see the whole company focus that way. So at Seedlegals, you know, if you hit us up on web chat, you know, any of our team can see the web chat. And I know that, you know, we'll tag each other. So I don't need, you know, if someone can't do something on the platform, in general, I don't need a complicated, you know, UX thing to write to the CTO to file a ticket to do something, because the CTO, someone would hit them up and go, hey, the customer's having a problem, and they would then probably just look to fix it. And so can we improve something? Yeah, our mantra is, if you've got a problem, let's see if we can fix it in the next 24 hours to make it better for you and everyone else. So if I see the company obsessing around the customer, that's a really good sign. And it means that you will rapidly iterate rather than building stuff for months or years before realizing. So everything so far has been really about before you've got a product. But as I said at the beginning of this, once you've got a product, then you're switching gears. And so now investors, because they were making a bet beforehand on you and your vision and how you plan to execute, once they see some level of traction, then they're going to want to look at the Excel spreadsheet. But one of the things I see in a pitch deck is, of course, people making claims of their traffic and so on. And there, I like to do my own research. So if someone tells me I've got so many thousands of hits a month or whatever on my website, well, I can go to similarweb.com and check that myself. Or if someone says I've got so many downloads, you can go to App Annie and you can see their download ranking and numbers potentially. Or you can just look at the number of Google, App Store app reviews, and if you've had 3 reviews, it's like, okay, you probably haven't had the 50,000 downloads you've got, or why is no one reviewing it? So, you know, when you make statements about your traffic, assume that an astute investor is going to go check it. So don't make claims that you can't justify. So now comes the next thing, and now we get very briefly, and I'll cover this only in a few moments, you know, as we get sort of into the legal. So now you want to raise some investment. And in your pitch deck, one of the key things is at the end, it needs to end with an ask, because too often I see a pitch deck and, you're showing me all the cool stuff you're doing. And then at the end of the deck, it just ends. And I'm going, that was super cool. Why are you showing this to me? So here, if you're in the UK and you're looking for you know, a few £100,000 from angel investors. It's going to be all about those SEIS or EIS tax incentives for investors. And if you're not a UK company, it's a little known secret. You can still offer UK investors tax breaks, and that fuels the UK ecosystem. But we won't go there. So one of the key things is now, how do I value my company? And here, I think that, you know, it's one of the most difficult things, as Richard spoke about. You know, if you don't have revenue, how are you going to pick your valuation? So here, very briefly, I think people pick a valuation in one of a few ways. You can read TechCrunch and then take a 0 off the end because they're insane American valuations. Or you can read publications like UK Tech News and see what everyone's raising. But the problem is no one says how much their valuation is. They just tell you how much they're raising. So that's no use. Or you can take a spreadsheet and you can model your future revenues and then put some multiplier on it to come up with the valuation. But as the investor, I think that's BS. You know, I take that with a grain of salt, because companies, founders just make up numbers. It's like, yeah, I'm going to do $1 million in revenue the first year, then 5, then 50. I've seen pictures where companies are doing, you know, more revenue than a FTSE, you know, 100 or FTSE 500. In other words, the 500 biggest companies in the UK, you know, by year 4. It's awesome if you do that. You'd be bigger than Twitter, faster than Twitter, but statistically unlikely. So I'm really, if I see that, not sure about all your arithmetic or all of your thinking. So that doesn't really work. So what I see on Seedlegals is companies selling, giving away in a sense, a median of 15% equity. And that means you simply take the amount that you want to raise, multiply it by 5, so the investor owns 1 in 6, 15% roughly. And so let's say you were looking to raise £200,000. You multiply that by 5, that would imply generally a £200,000 fundraise goes with a £1 million pre-money valuation. And that would be, you know, norm. So now, of course, I've just kind of answered one problem with another problem, which is how much should you raise? So what I found is in the UK, of course, every idea is different, but the way startups work is remarkably self-similar. And so you end up, you know, in a few different zones, so to speak. So the first zone is you as the founder or founders would put a median of £26,000 of your own money into the business before you go for an external investment, because no one invests on a PowerPoint. The next thing, and now I'm going to switch off screen sharing so that I can get back to video. So now the first thing is you put some of your own money in. Then you might do a friends and family round, raising 50 or 70,000 pounds or something like that to get to launch. Then if it's in the UK, the standard pattern is you might raise 150,000 pounds, giving your investors their SEIS tax breaks. And then you might raise a 500,000 pounds seed round, and then maybe £1 million or £2 million Series A round. You may not do all of those, you may do some of those. But what I think is really interesting is I think companies look to raise 3 rounds such that you give away or sell 15% equity each time. And if you do 15% dilution 3 times and you make a 10% share option pool for your team, the founders still have more than 50% after the 3rd round. And then either you don't need to raise more or you're looking to sell your company. So all of which is to say, to wrap up, if you think about, you know, what is your goal as the founder? Your goal, of course, is to become investable by putting some money in to create something, creating the buzz, cut through the noise, have investors want to focus on you, and then potentially raise money 3 times so that at the end of that, you don't need to do it again, and look to dilute maybe on average 15% each time, so the founders still have the majority of the shares afterwards. So, so that's the, you know, if you sort that, then you've got it made. It's of course easier said than done. So thank you very much. Mercedes, back to you.
So it's on you. All right, so I thought we would go to some question and answer. I think we've kind of covered this a little bit in both presentations regarding what is needed for investability, but I thought I would just kind of cover it from my perspective. So there's a lot of you that are starting with ideas and you haven't necessarily launched and you're looking around for funding. Typically you won't find funding unless you're very specialized or you come from a background that you need a ton of funding. So what would that background be? I would suggest that would be aerospace or something that is aeronautical where you need millions and millions of dollars, and chances are you come from a scientific or engineering type background. Otherwise, the best thing that you can do for your company is to get clients. Revenue is king. So, you know, depending on the price point, I mean, that's going to be several thousand clients or it's going to be a minimal amount of clients. So I don't know, Richard, if you want to just kind of take that and expand it just a little bit more.
Yeah, I mean, I think the other piece of this obviously is friends and family, right? So before you're going out to raise money from people that you don't know, probably you want to make sure that you've tried everybody that you do know. And again, that's not something that everybody can do. But if you do have the option of borrowing or getting some investment from your friends and family, then that's obviously a great place to start. Not everybody has the ability to invest in their own business. Not everybody has the ability to put cash in their business beyond the time and effort that's obviously also required. And we all have to live and rent and buy food and all that kind of stuff as well. So one way or another, I mean, I think the really important thing though here is before you go out to market, and it kind of goes back to my previous point about making sure that you're doing everything you possibly can do sort of to avoid fundraising. One of those things is to be really lean in the amount of money that you're spending. So making sure that every penny counts, but also in doing everything you possibly can do yourself or with your co-founders to ensure that you don't need to raise money until you've maximized the proof points for your idea.
Yeah, I think a lot of that's about validation. So one of the exercises that we do at the Founders Institute is that we make sure that people go out and interview random people. They also use tools like Prolific to survey mass numbers of thousands of people to determine, you know, is my idea worth any salt? And you know, you're going to get a lot of people that are going to say, oh yeah, I love the idea. But if you put them on the spot and say, hey, will you, contribute 10 pounds and put it like in escrow until maybe I actually launch my app or whatever the case is. If they're not willing to part with the 10 pounds right now, then chances are they actually don't like your idea and they were just being kind. So, I mean, the Founders Institute, we don't really rely on kindness. We really rely on what you can prove and what will get you to that next level for investment. So another question that we had that I thought was pretty interesting. Richard, this was about Capital Pilot and where are you targeting startups all over Europe or just the UK? And is there a minimal size of business investment that Capital Pilot will consider to support?
So at the moment, we're very much focused on the UK, and certainly our 50K Boost Fund is UK only. So we can only look to invest once the fund is launched in companies that are UK registered. We can do ratings and assessments among UK based businesses, as long as currently it's all in the English language. We're working on moving beyond that, but we can do assessments and ratings. We can't do investment.
Okay. So there was a question from Massimo. I hope I pronounced that correctly. It said, are pre-seed incubators a good way to access the investors network? I think that, well, I might be a bit biased, but from my perspective, I have a lot of people that come through the Founders Institute. Our methodology is actually to kick people out if they're not doing the work correctly or they're not kind of hitting our minimum expectations. So we may start with a group of 50 and end up graduating, I would say 10 to 15. But what I will tell you is in one of my last cohorts that graduated, want to say February 19th, right before COVID. 5 of those guys ended up with investment. They definitely were the strongest in the program. But every one of their investors actually did reach out to me, and they reached out to get references. So just because you have a great idea and you have some traction, that doesn't mean that in the background that investors are coming back and finding out what type of person you are, you know, how lazy you might be, you know, if your idea is actually real. So they do reference checks on you. So I do think it is a good way, because if you get a reference from me, then chances are like your gold, 100% of the people I've given references to have received investment money. So Richard, Anthony, I don't know if you have any thoughts about that. Both of you have gone through investment rounds as well.
Yeah, I think I was about to say that it's kind of interesting, which is when I first was on a panel or on stage with Mercedes, I realized she's quite brutal. So for me, it's all about mentoring people and helping them, you know, become investable. But actually, I think what Mercedes has done is gone the step further to go, listen, using data, I've seen that in many cases, you're wasting your time. So I'm just going to tell you up front, you're wasting your time. So it's a bit like astronaut training program. You know, if you make it through the astronaut training program, you'll get a gig in space. But otherwise, we're just going to get rid of the ones that weren't early on. And I think it's really interesting because, you know, being a founder is hard. You know, you've got the weight of the business on your shoulders. You've tempted people away from their day jobs elsewhere. You can't just after a year go, you know what, I'm bored. I feel like, can I just give this baby back again now, please, and do other stuff. So, you know, what my goal is to give you information so that everyone has the potential to, you know, I guess, you know, deliver that vision, to be the founder. But then I think what Mercedes is doing, the next thing is to go, actually, at least if I show you fairly robustly if you've got it or you haven't, it doesn't mean innately, but you may need to do these 5 things, give up your day job, focus on this, don't do that, run it like a military operation, then you're poised for success. And I quite admire that. And yeah, so I don't know if that answered the question at all, other than to say, you do need to be laser focused, I think, if you are going to take that dream to fruition and go and change the world, I guess.
All right, so there was a question about in the B2B domain, it's quite challenging to just start with the MVP at hand. So how does traction still play a role to impress investors? I don't see a difference between consumers and B2B ideas personally. From an MVP standpoint, obviously you'd have less companies that have signed up. So I think at a minimum, like having 5 using your MVP or 5 that helped you co-develop as kind of your first stage, and then going on and finding maybe 10 more clients. The thing for me is I like to bootstrap a company as much as possible. And the reason that I do that is because I want the least amount of investment and equity going into, well, the least amount of equity going into the investor. So I want to protect your equity as a founder as much as I can. There's a lot of people who are very different than me. They're like, hey, just give it all away. But that's not the best thing for you as a founder. So Richard, Anthony, thoughts?
I think that's absolutely right. And I referred to this very briefly in my comments earlier on, which is traction doesn't necessarily have to be any particular metric. But obviously what an investor wants to know is that the thing that you're building has a user base and that you can demonstrate there is excitement and interest in what you're doing. It's not just the idea that you've built in your own garage. So, so that's the key thing to it. And whether that's through references, testimonials, you know, letters of intent, there could be all sorts of different forms of traction and proof points, and it'll be very specific to your particular business. But just because you're B2B doesn't get you away from the need to demonstrate traction before investment.
Yeah, so if I can hop in, frequent question is am I ready to go and get investment? And my answer is the time is right for getting external investment when either you can't afford to fund it yourself, or you've reached the valuation that it makes sense to now give away the right amount of equity for the investment that you are looking for. So as my business partner reminds me, you can't own more than 100% of your own company. So at some point, it makes no sense to keep putting more of your own money into the business. But if the business has a valuation of £50,000, you're going to give away, 10% of the business for like £5,500 or something. It makes no sense. You should just put the £5,500 in. But if it starts now, you've got, several people on your team and it's costing £10,000 a month to run the business, at some point your spouse is going to notice you spending £10,000 a month on a hobby, and you've got some explaining to do, right? So somewhere between then, it's probably going to cross over into now is the time to raise investment. So really, I think the time comes when one of several things. Firstly, you've proved the hypothesis, and now getting more money than you can put in yourself will get you to scale faster than you could yourself. And maybe that's really it. So in the really early stages, when you're ideating and the three of you, adding more money won't get you there faster. But once you've now know that people want it, and you need a marketing person, you need to spend some money on advertising and so on, then more money will get you traction faster, and therefore it makes sense to raise investment in order to get to revenue or traction faster.
All right, so we have a question from Dan. So he says, after COVID, it seems that achievable margins and a clear path to profitability is more important than growth at all costs. Does this change the startup mentality? So I actually will let you guys answer, and then I might follow up.
I'll hop in first. That's a really great question. So I must say, between me and my business partner, I'm the kind of guy that says, yeah, let's spend lots of money, let's launch in 12 countries, let's own the world, people love us. And my business partner goes, no, we're going to, although I'm an ex-VC, I've seen too many companies run out of money, or because I'm an ex-VC, I've seen too many companies run out of money. What you should do is, raise and then look to get to cash flow break even. So he takes a much more conservative view. And when COVID hit, we were in the very good position that we had a very small burn rate. We had a good cash reserve. And so we didn't have problems. We didn't need to furlough people. We could say, all right, if business, decreases, we don't have a problem. We're not about to run out of money. And so I think the challenge you have is if you run this insane growth thing that we keep reading about when we see companies raising millions, it's highly risky. It works if, A, people want your product, B, you can get more investment to fuel it before you run out of money, and B, there's no perturbation in the world that screws everything up. But it's highly risky, and so you might be much better off to say, let's take a more modest approach. Let's look to get to cash flow break even, or a modest burn rate. So my cash is going to last for 2 years, and only when we see growth do we raise. And so that's in fact what we started at Seedlegals. The way we did it, we agreed between each other, my business partner and I, what our maximum monthly burn rate would be, so that the money we had raised would last for 2.5 years. And then as revenue increased, we hired more people, but kept going with that sort of burn rate of £40,000 a month, I think. And even to today, that's the comfort zone for us. Even with now 60 people, we like to not be much different to that. So I have learned that the more conservative route leaves you maybe champing at the bit and being slightly jealous of companies that raise millions. But on the flip side, when they implode later on, you can feel actually a smug feeling that your business is still going and is still sustainable.
Really not much to add to that, other than Yeah, I kind of agree. And think about it from the investor's perspective as well. If they're slightly more risk averse right now, they're less likely to want to risk their capital and more likely to have more proof points when they do risk their capital. So pushing a little bit further ahead, doing more yourself before you ask for money, striving to get as close as you can to profitability or on that road obviously makes more sense in today's scenario than it did.
So I read something a couple of years ago, and I can't remember who said it, but they commented that startups and fundraising are a little bit like a Ponzi scheme, in the aspect that people are always trying to go for these like crazy growth curves. And they would go invest or get in round of investment. They would do a ton of growth. Oftentimes that might be a freemium type growth, but their revenues actually weren't equating to their growth metrics. So then they have to go invest more or find another investor. That is not an ideal way to do business. And how you know that is knowing that something like 50% of VCs in various areas around the world are going broke. Because they have had so much growth and they haven't been covering cost. So at a bare minimum, I mean, like what Anthony was basically saying is, you know, make sure that you can cover your cost, have some reserves. So if something like a pandemic does happen, or 9/11, or some of the tragedies that we've had in the past with the financial sector, that you're able to cover yourself moving forward. You know, it's quite easy to put everything on the line and you'll burn. And that's exactly the climate that we're in right now.
That's right. And investors, one of the key things, exactly as the question said, I think if I was an investor, you know, some investors just procrastinate. Well, we'll wait for things to come back again. But I think the hottest companies are raising because they've got a proposition. And therefore, the best investors are also investing because they don't want to miss out in those companies. So I think the recovery cycle is actually very quick. But if you're an investor, you want to pick, because now you've got a wide range of founders. Some of them just happen to be, unfortunately, in a space that is highly affected. If you're a restaurant, life is going to be tough. If you're a healthcare, you know, app or a SaaS business, you may be either positively affected or somewhat unaffected. But I think as an investor, if I see a founder opportunistically taking advantage of whatever situation, maybe this is the time to hire people. You know, finding great tech developers in London is kind of impossible. Actually, there are some becoming available. So if you had cash reserves, now's the time when you could find tech people and pay recruiters potentially a lot less, or just they'll come to you. So you've got a lot more options available, and I think investors will be looking for founders who are acting that space, don't have a crazy burn rate, will survive if business is down for the next 6 months. So those are the signals you want to give.
All right, so everyone had a question. I have an idea never invented before. Do I need to make a prototype to demonstrate the proof of concept? I would say yes. I think it really depends, like your sector though. I mean, that's a pretty open question. Again, if it's like aerospace or aeronautics of some sort, then you probably need to have just an excellent background with credentials.
If I can hop in, I mean, I think everything about investing is the investor taking a level of risk for a given amount of reward. And so your valuation goes up proportional to how success is already delivered. So different investors will have different risk appetites. Some of them will invest on your PowerPoint, or, you know, over a dinner of waving your arms or drawing it on a napkin. But realistically, they're not going to put either much money into it or at a really high valuation, unless, you know, they're super bought into you. I mean, if you've exited your last few startups for many millions, then you've got cred and people are betting on you. But for the most part, that's why, you know, as I suggested, you know, over several rounds, your valuation increases. So you'll find it quite easy to get friends and family to invest 10K each in your business. So you'll fairly easily be able to raise 50K at a $500,000 valuation. But no one's going to invest hundreds of thousands of pounds and millions valuation just on that idea. So now you need to, over several rounds, get to the point that you can do that. And it's all about having less risk each time by showing more and then priming the pump so that you can put your own money in, so you're not giving away equity too soon.
Right. So, so I'm going through these chats. So I'm kind of curious, Anthony, I know you have some stats on this. So how much do you see most companies giving away in their first round, starting with the friends and family, and then maybe going to a secondary round of equity?
Yeah, I think it's, you know, a median of 15%. I think in the first round, ideally it should be less because, you know, you might only be raising a fairly small amount because you can't justify a very high valuation. So maybe you're going to raise, you know, on a $500,000 valuation, or, you know, you might give away 10% and raise 50 to 60K, something like that, potentially. And I think that's what I see as the norm. Now, you know, in later stage rounds with VCs often want more skin in the game. So you may need to dilute by 20 or 25%. You might then, you know, that may be fine. I think, however, when I see companies, you know, selling at 30% or so, or you have, you know, often perversely, it's not super smart VCs, it's slightly well-meaning but naive family members who go, yeah, I'll invest 20K, you know, for 40% of the business because, you know, of course, you've just had this idea last weekend. How can it possibly be worth £200,000 already? Or investors want strange things like a guarantee of their money back and so on. So, you know, in early stage, you should only give your investors, you know, ordinary shares. You should never promise them anti-dilution or non-dilution and so on. You know, you may have to later stage when you get to VCs, but, you know, and you can hit us up on Seedlegals if you have an investor asking for anti-dilution or non-dilution or weird stuff like that, because it can really kill your investability later.
So this question, I think I'll leave for you, Richard. How would you evaluate a startup or its pitch when they're in the entertainment market and they're making a social network? For example, they do not have a precise problem to solve, but something like TikTok or Twitter, how would you take care of that within your investability ratings?
I mean, there's one of the things to say about that marketplace overall is that there are some extraordinary examples of sort of defying gravity, right? And you've just mentioned TikTok. I mean, there's a whole array of other businesses in that sort of customers don't need it, but they may end up wanting it. You know, WhatsApp, you know, what was wrong with SMS, right? WhatsApp's come along and it's created an extraordinary new marketplace, and there are many other examples along the way as well. So it is an interesting one, and I think that with consumer businesses like that in general, which is largely entertainment driven, there's something about novelty. There's something about the differentiation versus other similar systems, and traction, momentum actually, rather than traction, is probably really, really important to investors. That is the rate of change of traction, how quickly you're growing your onboardings of consumers. So as we look at investability for businesses like that, we take them through exactly the same process as we do B2B businesses, for example. So it's the same questions that we're effectively asking of each business, irrespective of whether they're B2B or B2C. What we're really looking to, though, is to ensure that momentum in terms of the growth is aligned with the likely marketing expense of building a product or service into mainstream. So one of the great Bibles of early stage investing is Crossing the Chasm, written, I think, first about 25, even 30 years ago, but republished and updated quite recently. And this talks about the idea that you can have very sort of early adopters in your marketplace. You've got the first 100, the first 1,000 consumers using your product, but to get from there to the mass market and to have hundreds of thousands and millions of users, you have to cross the chasm. And there are different things you need to do as the owner and founder of a business to be selling to mass market than proving that you can build a network of early adopters. So those are the kinds of things which would be important in evaluating a business of those sorts, and being able to prove that you have considered how you cross the chasm effectively, I think, is a key area.
So I did get a question about where to receive investor funds, perhaps from out of country, and if that makes it harder. So, I mean, I do have a couple of suggestions on this, particularly, I'd say that Luxembourg tends to be a popular place, as well as the UK, specifically out of London. And
is that for investors or for basing your company?
For foreign investors. So like where to go and get investment rounds. And then obviously America, Silicon Valley tends to be a very popular place from where I'm from. I'm kind of curious, Anthony, what kind of data do you have as far as like where people are receiving investment?
Yeah, I think 95% of all investment is from people in your own country. You know, investors know the local laws, they invest in other things in the same country. And I think when people look in other countries, I mean, sometimes, you always at some point may outgrow your pond. And so you see sometimes the most ambitious founders will head off to Silicon Valley. But when I do see companies looking to raise from investors in other countries, it's often, it's one of two things to me. Either they've lost focus or they've been unable to raise funding, and so they think by looking further afield they have, or otherwise it may turn out people have just got family in Middle East, India or wherever, and actually they can efficiently reach out to them. So there's nothing wrong with looking elsewhere, but I think by far it's like literally 95% of investment would be people in your own country. So now, can I do a quick fire, go through a few of the questions to see if I can cover a bunch of them quite quickly? All right, so let me see if I can cover a few quickly. Number one, there was a question about Innovate UK and government grants. So that's a great question. Will government grants count as validation? I think there are two parts to that question. One of them is, do they count as validation? Yeah, kind of. It's nice that, someone's given you money, clearly with some criteria, and you haven't had to give away equity, so that's good. But I think the flip side of it is the effort to apply for government grants could have been spent on other things. So, in my zeal for laser focus on what's going to be the thing that gets you to success fastest, you can spend 6 months waiting for various government grants to come through and Innovate UK, or you can use that time to do something else. So when I see people fixated on government grants, that to me is either a sign of, okay, they really are in a space of med tech or university or whatever, which is just perfect for that, or it might mean they're afraid to go find investment, or they are kind of spinning plates slightly ahead of going off and finding investment. So to me, it's a mixed message. The next one is, what are the most common conditions to pivot a business? So I think that's a fascinating one, because in a sense, as a founder, you're always micro pivoting to macro pivoting. And I think there, once you have gotten to product market fit, you're now always wondering, do I just keep doing the same thing, or one day I'll be out disrupted and out of business, or do I change things? But that's a nice problem to have. But until you get there, you've had your heart set on something, you launch it, 12 people come. And now the biggest thing that you usually think is that you're one feature away from success. For my social network app, because we were talking about that a minute ago, if I just add an extra follow button, or I change the design, the traffic will take off. And you try that and it doesn't. So, this is really, really frustrating for a founder, and I've been there, which is, should you massively pivot the business? Do you add more features? I think one of the things I've learned is that adding more features usually doesn't make you a better product, or doesn't get you to success. And I think I've also seen that consumers figure out in the first 8 seconds what your product is. And my perfect example is Twitter. They've tried all this stuff. They've got the Twitter video thing, they've got buy, they had discover, they've got social, there's stories, all the stuff they tried, every single one of it has failed. Why? Because the only thing we see Twitter is it's a feed of stuff. The only thing that's actually worked is they made the 280 characters instead of 140, but that's the same proposition. Nobody wants Twitter to be anything else. And what I realized in one of my startups, as I added these extra features, people had looked in the App Store going, your product does X, I'm just looking for it to do X. So often getting rid of features and finding, before you spend a lot of time and effort building the thing, mocking it up, making prototypes and figuring out what it is, and then focusing of that. And of course, then you still have with the problem when people don't come, you know, what do you do next? And that's one of the challenges that you're going to have to address as the founder. And I don't think there's a magic answer there. All right. Any other question? Because I can't talk and read at the same time.
By the way, you repeated the word pivot. We'll can't pass on from that. All
right.
Excellent. Well, I wanted to thank both of you, Richard and Anthony, for joining tonight's webinar, as well as all the attendees. It looks like it was well attended. You can definitely reach out to all three of us on LinkedIn. If you are in that idea phase, or maybe within your first MVP, or have low traction within your business, I'm happy to talk to you about joining the Founders Institute. I'm sure that both Anthony and Richard are happy to talk to you about investability or how to go about rounds. Both companies actually are pretty, I think, amazing for the startup founder. You know, the Capital Pilot gives you, I think, almost a 25-page report as far as like the pros and the cons of your business. You know, companies that don't score really well in that investability report actually oftentimes go and change kind of all those metrics, and they get investment after that, which is actually quite exciting. And then Anthony, I mean, you have saved so many of my founders lots of money on rounds of funding, just because they haven't had to pay high investment fees or legal fees. Anthony's able to take care of it kind of out of the gate, allowing for that working capital. You know, when you have a 75,000 round and you find 25% of it's going to fees through a VC, it's something that makes me choke. It really makes me angry. But I think, Anthony, if I'm correct, is it only about 2%, 1.5%?
Yeah, I mean, my goal is that you should spend less than 1% on your, you know, legal fees. Obviously, if you're raising 5K, it might be higher, but more than 1%, I feel like I'm taking too much. Yes.
Yeah, how can you not love that, everyone? Anyway, thank you so much for joining. I will make sure that this webinar is sent out to attendees, and like I said, you can reach out to us on LinkedIn. So thanks for joining tonight.
Thank you, and thanks for the amazing questions as well.
Yep. All right, thank you. Bye-bye.